What if I told you that you can control a large position in the stock market with a relatively small amount of money? Sounds exciting, right? But here is the problem. Options trading can multiply your profits, and it can also multiply your losses. So before you buy your first call or put option, you need to understand what you are actually trading. In this video, I'll explain options trading in the simplest way possible. No complicated mathematics, no confusing terminology, just the basics every beginner should know. And make sure you watch until the end, because I'll also explain the biggest mistake beginners make when buying options. Let's start with the most basic question. What is an option? An option is a financial contract that gives you the right, but not the obligation, to buy or sell an underlying asset at a specific price before or on a specific expiry date. That sounds complicated, so let's make it simple. There are two basic types of options: call option and put option. A call option is generally used when you expect the price to go up. A put option is generally used when you expect the price to go down. That's the basic idea. Call option. Let's say you believe a stock is going to move higher. Instead of buying the stock directly, you can buy a call option. If the stock moves strongly in your expected direction, the value of your call option can increase. For example, imagine a stock is trading around 1,000 rupees. You believe it may move to 1,050 or higher. You buy a call option. If the stock rises quickly, the option premium may also rise. You can potentially sell the option at a higher premium and make a profit. But remember, the stock going up does not automatically mean your call option will make money. This is where beginners make mistakes. Put option. Now imagine the opposite situation. You believe the stock is going to fall. You can consider a put option. If the stock falls strongly in your expected direction, the put option may increase in value. So remember this simple rule. Call means you are generally expecting up. Put means you are generally expecting down. But options are not simply about predicting direction. There is something much more important. Option premium. Every option has a price. That price is called the premium. For example, if an option premium is 50 rupees, that 50 rupees is the price you pay for 1 unit of the option. But the premium keeps changing. It can increase. It can decrease. And sometimes it can fall very quickly even when the market is moving in the direction you expected. Why? Because option prices are affected by several factors. The underlying price, time remaining until expiry, volatility, and something called the option Greeks. We will cover these in future videos. Expiry. Now let's talk about expiry. Every option contract has an expiry date. As the expiry gets closer, time becomes very important. An option that looks attractive today may lose value quickly as expiry approaches. This is especially important for option buyers. Why? Because of something called time decay. In simple words, time is not always your friend when you are buying options. The closer the option gets to expiry, the faster its time value can disappear. That is why buying random options just because they are cheap can be extremely risky. ATM, ITM and OTM. You will also hear 3 very common terms in options trading: ATM, ITM, and OTM. ATM means at the money. ITM means in the money. OTM means out of the money. For example, if a stock is trading around 1,000 rupees, the 1,000 strike may be considered ATM. Different strikes above and below the current price can be ITM or OTM depending on whether you are looking at a call or a put. Don't worry if this sounds confusing right now. In the next video, I'll explain ATM, ITM and OTM with a very simple example. The biggest beginner mistake. Now let's talk about one of the biggest mistakes beginners make. They look for very cheap options. For example, they see an option trading at 5 rupees and think, if this becomes 50 rupees, I can make 10 times my money. But the market doesn't work that way. A cheap option can remain cheap. It can lose most of its value. And sometimes it can expire worthless. So never choose an option only because its premium looks cheap. Always understand the underlying asset, strike price, expiry, volatility and risk. Risk management. And this is probably the most important part of options trading. Never risk money you cannot afford to lose. Don't use your entire trading capital on one trade. Don't increase your position size just because you lost the previous trade. And don't trade simply because the market is moving fast. A good trader is not someone who wins every trade. A good trader is someone who manages risk when the trade goes wrong. If you are serious about learning options trading step by step, follow this playlist. So subscribe to the channel, and let's learn options trading together.